This is Robert Sharpe for Solomon Prime, and we're discussing Introduction to Covered Calls. It's important that when you trade covered calls that you're aware of all the risks that are involved, and please read through this risk disclosure. We will be doing a separate video specifically regarding the risks involved with a covered call. But everything here is intended as educational material only. Please read through the entire risk disclosure. So how do covered calls actually work? Basically, each month we select a handful of stocks that meet a certain criteria, and we're very strict about that criteria. That criteria includes, first and foremost, a stock that we wouldn't mind holding long term. I've really got to believe in this stock. Okay, it would be because that the particular details and fundamentals of that stock, or the industry, the sector has a lot of growth and it's in an uptrend. Something fundamental or a macro issue that gives us reason to believe that this stock is either going to stay flat or go up. Okay, we don't need it to go up a lot. We just need it not to go down. And so we're looking for a stock, and it's important that we pick the right stock, especially when it comes to covered calls, because when you buy a stock, you really are becoming a part owner in that company. So we pick stocks that we really believe in, and this includes, value. We believe, that it's priced right and has a lot of room to grow. It's got to have relative safety. In other words, we don't want a fly-by-night company here or anything like that. We want to know that there's a reason to justify our purchase. And timing, is this the right time to get in? Did something happen in the company that now has generated a lot of interest in that stock? Okay, so that there are a lot of other people that want to buy it too. So I can't underestimate the importance of this step. When we purchase a stock for the covered call program, it's not the purpose of this or the intention of this video to discuss all the work that goes into that, but we put a lot of work into choosing the right stock. Okay, but one of the most important elements in choosing the right stock when we do the covered calls is that it's got to be a stock that something has happened that we believe that the stock is about to pop, and not just that we believe it, everyone has to believe it. It's usually, for example, in a stock in the energy sector. Maybe a small company is looking, doing some research and potentially on the verge of discovering a new oil reserve or gas reserve, in some basin somewhere in the Ukraine or somewhere in Asia or even in the U.S. And when that's the case, if they do, discover that, if they do get that breakthrough, that stock is going to break out and is going to pop. And many times, especially when it comes to these smaller companies, they break out twice. Once when they get the discovery, and then oftentimes a bigger company. For example, in the energy sector, it might be Exxon comes in and buys up the smaller company because they want the resources that they have. It also happens oftentimes in pharmaceuticals or biotech industry, where a particular company has several medicines in the pipeline to be presented to the FDA, and maybe they presented they just got great results on some testing, or about to, it's believed that they're going to get approval from the FDA, and so everyone's really interested in these stocks. And so if these things come through, these things could literally double in price overnight. And when they do get these breakthroughs, and if it's good enough breakthrough, then again, another bigger company might come in, like a Merck might come in and buy up these companies. Okay, so these are stocks. We don't just believe that they're going to pop and we like them. Everyone is watching them. Okay, that's a huge part of the criteria. Everyone has to believe these stocks are going to be going up. And in these kinds of scenarios, big investors are waiting for the right time to come in, and they're willing to pay to control the stock. And that's really what covered calls are all about. So let's break it down a little bit. Okay. Now, what we do is, once we've determined 2 or 3 stocks each month, and we find 2 or 3 each month that meet our criteria, we go ahead and we buy the stock. Okay, we don't mind owning it. We want to own it. We believe it. We're excited about it, and so is everybody else. So we go ahead and we buy the stock. Okay, and what we do is immediately we sell the right to buy the stock from us within the next 30 days at a higher price. Okay, so we buy the stock and we immediately sell the right to buy this stock from us within the next 30 days at a higher price. So here's a quick example. Recently, we made a purchase of UVXY, and we bought it at $16.25 per share. Okay, and then what we do is we immediately sell the right to buy these same shares from us, but at $17 anytime within the next 30 days. So when we sell this right to buy, this is what is called a call option. A call option is when we sell a call option, we are selling someone else the right to buy our stocks from us at a specific price. Now, so we are buying the stock and then we are selling a call option or right to buy these stocks. So remember, the stock that we're buying should be an excellent stock. It's going to be a stock that we don't mind owning if we end up owning it for the next 10 years. We're going to make money, maybe dividends from it. It has potential to growth. It's a good stock. And then in addition to that, we sell a call option, a right to buy the stock from us at a higher price. Now, for this right to buy the stock from us at a higher price, what is called the call option, for this call option, we're going to receive a payment. Makes sense. We are selling something, and so we're going to get paid. This payment in the options industry is called a premium. So when we sell a call option, when we sell someone the right to buy, we receive a premium. We receive a payment. This premium is usually going to be between 5% and 28%. Normally it's going to be around 15%, but we have placed several calls every other month or every 2 or 3 months that is paying a lot more. And it's got to be worth it, is really the bottom line, And this is the premium we're going to receive every month on this stock for the foreseeable future. So we're going to receive 5% to 20%, usually around 15%, 10% every month. So the premium that we're going to receive is about, let's say, somewhere between 5% and 28%. And so here's an example. We buy UVXY at $16.25 per share on April the 18th of April. We immediately sell a call option, the right to buy the shares from us at $17. Now, look at that $17 number right here. This $17 number reflects what is called the strike price. So this is the price that someone's going to have the right to buy it from us. So we're buying it at $16.25, and we're going to sell the market the right to buy these shares from us at a $17 strike. And for that, we're going to receive a premium. We're going to get paid. How much? In this case, $2.55 per share. Now, in order to trade covered calls, you do have to buy the shares in 100 share increments. So in this particular example, we would need to pay $1,625 for 100 shares. Now, we do have, oftentimes, most of the time, we always offer something that is, lower, sometimes as low as $10 a share, and sometimes stocks that are a little bit higher. But you're going to have to buy 100 shares, and that's the point there. So you're going to receive $2.55 per share of premium money times 100 shares. So you're going to receive $255 in this case. Or if you were to buy 1,000 shares, you would be receiving $2,555. That's what you're going to receive just to hold the stock for 30 days. A stock that you are willing to hold anyway, a stock that you believe in. So what makes this all doubly exciting is that all options have an expiration. Okay, when you are selling an option, when you're selling the right to buy, you're not selling that right to buy forever. You're giving them 30 days. You're basically giving them to the expiration of that contract. You can do it longer if you want, but this typical covered call is going to be a 30-day contract. And specifically, all options expire the third Friday of the month. So if you are buying the stock, let's say in the beginning of July, and you sell a July option it's about a 3-week hold, that you're holding the stock for about 3 weeks, and you're going to get premium to hold that stock for 3 weeks. So all the options expire the third Friday of the month. Okay, and so let's put this together. Very simple. We purchase a stock that we like, that we love, that we believe in, and so does everybody else. We sell a call option, a right to buy to the market. We're taking advantage of the fact that they want it. We sell a call option, a right to buy to the market, but at a higher strike price, and with an expiration for the following month. So usually we're holding a covered call for 30 days or less. And for this, we receive a premium. And that premium is mine to keep no matter what. And the following month we do it again, and we do it again, and we do it again, over and over again. And in most cases, you don't actually need to buy the stock again, because at the end of the month, oftentimes these options expire worthless, and we go ahead and we just sell another option against it again, and generate monthly income. So that is basically how covered calls work. This is part 1. In a moment, I'll be showing you part 2. Thank you.